You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. And no matter what end of the spectrum you fall on from an options perspective, we have a program for you on the network. If you're into the hardcore institutional side and you love to see some of the tech that powers all the cool trading we talk about here on the network, then we have a new show for you, Trading Tech Talk. Check it out. I think you're going to like it. And if you're on the more basic side of the fence, you want to learn some more basic option strategies, perhaps in some sports relatable terms you may have a better understanding of, then check out our Options Playbook Radio, where we break down a lot of options plays into offense and defense, income, all that fun stuff. A lot of great stuff. So we cover the full spectrum over here on the Options Insider Radio Network. And while you're checking out those new programs, by all means, surf on over to your app store and download the Options Insider Radio Network mobile app. I know many, many hundreds of you have already done so, and we love to see that response to the app. It is, of course, available in the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store for all you Kindle Fire lovers out there. I know there are more than a few of you lurking out there, so wanted to make a version for you. Of course, you can stream all 100-plus episodes of Volatility Views instantly from pretty much wherever you are on the planet, wherever you have signal. You can also download them, listen to them later offline when you're on the subway or on the plane, wherever you like to listen to this fine program. And of course, you can click that contact button and send your feedback, your questions, your comments directly into us here on the show so we can check them out and get them routed and get them answered in a timely fashion. So all that fun stuff and much more, check it out, the Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the old Volatility View show today, starting off with my new compatriot, my new partner in crime, beaming in from the hinterlands of rural Virginia, where he just got off horseback just for this show. None other than Mr. Jared Woodard from Condor Options and Klineman Financial Group. Jared, welcome back to the program.
Hey, thanks. I'm always excited to be here.
I'm glad you can take a break from your horseback riding to join us here on the program. Very generous of you, sir.
Oh, man, in rural Virginia, there's never any lack of things to do.
And speaking of the rural parts of the country, we are also joined from the hinterlands of Maine by none other than the rock lobster himself, good old Andrew Giovinazzi from OptionPit.com. Mr. G, welcome to the Volatility Views program.
It's been a while. Back from the Don Schlesinger days and the old Vol Views.
Do you still remember how it works?
I have some vague idea, yes.
We talk about this thing called volatility. You'll catch on. Just listen for a little bit and you'll fall right into the
Does
group.
that start with a V?
silent U and umlaut. You can go a lot of different ways with it. All right. And with the team assembled, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, there's that song I'm going to be humming in my head for the rest of the show. Welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week that was from a volatility trading perspective. And open to close, we are recording this, of course, on Friday, March 28th. But essentially, so far the week, open to close, at least from right now, it's been a bit of an unched week. From an overall vol perspective, we opened the week with a little bit of a bid in the old VIX cash, right around 1470. And when we started looking at it this morning, we were trading right around the 14 handle. Seems like vol is catching a bit of a bid as we go into the weekend with the VIX cash trading right around 14.63. So it is almost literally unched from open to close here towards the end of the week. If this trend continues, it will have opened at 1470 on Monday, and it'll be closing today right around 1470 as well. Of course, seeing a little bit of a bid out in the VIX term structure. No surprise there out there in the futures, with the front month future trading at about $1.50 or so premium to the cash, and increasing on out to there. And you get to the middle of the year, you get to July, looks like about $3.50 or so in terms of premium, all the way out to Dece, where we bid in a nice $4.50 worth of juice. So a lot of juice going into that futures term structure. A lot of stuff to digest and deconstruct here on the show. Andrew, since it's your first time back on the show, maybe we'll start with you. What really caught your eye in the week that was from a volatility perspective?
Really, the lack of just volatility coming down. I don't know. I guess I'm kind of full. I think, I thought the Russian thing was solved. I thought there would be a little bit more of a drift down to the 13 handle, maybe to stick around for a little while. I think what's kind of tripping people out is, we're up a half a point, then we close down a half a point. So we're having like a 1% round trip intraday. And it's just keeping the volatility from really drifting lower. And I think this was the first week where, we're starting to see basically the new kind of post-QE era, where I don't think there's a lot of support for there isn't that thing where the Fed's going to come riding into the rescue, so to speak. And I think the market's just starting to get choppier, starting to churn a little more. And close to close vol, it's not showing up, but intraday, it is showing up. And that's seeing kind of the turnaround today in the broader market. We opened up. Again, we have good economic news almost every morning, and then it falls apart. And I think what that's starting to do is the volatility just is having a hard time. I thought we'd see really low levels this year, but it's having a hard time finding that level. And until the intraday volatility slows down, it probably won't. We'll probably get more of the same.
Jared, same for you. What's your take on the week that was from a vol perspective here?
Yeah, I mean, in terms of equity index vol, I gotta agree with Andrew. It's been a big theme this year, really. In fact, just how sticky vol's been in some places, and I guess we've talked about this before in recent weeks too. How you can see days where the equity index rallies and implied vol just kind of doesn't really move. It looks like that trend of a high bid, a big bid for volatility in the front part of the curve is continuing. At the same time, selling a little bit further out has worked pretty well. And, I think this week was a continuation of that until we see a real change in investor sentiment. It seems like that's really the script.
Some other interesting stuff lighting up the old tape this week. We profiled this earlier on Insider. This week marks the first decade of VIX Futures. Seems hard to believe it's been 10 years, but it has been back in 2004 when they launched these contracts. So not surprisingly, they're putting out a few milestones this week to kind of celebrate that. The ADV just from the last few years, 2009, was 4,500 contracts, and now spiking up to more than 200,000 a day. Overall, VIX Futures total trading volume has surpassed 95 million contracts and is trading almost 24/7 now. So it is kind of crazy to think that this product that everyone and their mother really thought of as this just hardcore institutional product, a layoff pit for the market makers and traders out there in SPX, would really resonate to the degree that it has. Jared, has the adoption of not just VIX, but even the relatively hardcore VIX future surprised you?
Well, okay, so I remember when these really started taking off, and at the same time that some of the exchange traded products were being launched too, my attitude at the time was pretty skeptical about whether they'd ever be really adopted in a big way. I mean, if you want to trade vol, you can trade options, and that's what I do. And my thought was, what's the value of these sort of packaged products? And that was years ago, and my sentiment was clearly wrong, and I think they've proven their value. And I think one interesting way to track this is to look at how important VIX has become to the exchange. So right now, revenue from VIX futures is I think up to about 15 to 16% of their transaction fees, just the one product, and that's up from, I think it was about 12% about the same time last year. So the adoption here is huge, and it's really important, and so I think that growth is on a really steady trend, and we should expect that to continue. I think it'll be interesting to see whether they can find an audience for some of these newer products and see even a fraction of that kind of growth.
The best thing about the vol products is it's Vega without gamma, so it has a place. I think it makes actually trading options a lot easier, especially when you have peaks in market volatility and you don't want to mess around with all that messy gamma and curvature of a position. So to be honest, I think as customer education grows, even on the institutional level, you're going to see volatility trade just as much as the vanilla option products. And I only see it growing, to be honest.
Andrew, I want to get your take on something. So one question that comes up a lot is how these products get received and how they grow. And one theory is that the ETPs have been really instrumental in bringing VIX to a wider audience. And so as a corollary to that, as the exchanges try to launch new volatility futures and other volatility products, the thought is that, well, should they kind of shepherd or help with the launch of exchange traded products for some of these other indexes? And I'm curious whether you think that's a plausible story in the first place about VIX, and then second, whether that makes sense or if that's something to look for in these other volatility products.
Right. I think the key for a vol product is it has to have an underlying. Just watching how a tradable underlying. When they launched the VIX, it was kind of cool in theory, but without an underlying hedge, it took a while to catch on. The VXX and as long as they're not too complicated for a volatility product, I think in order for most products to be successful, you kind of have to have, it goes up, it goes down, and the reason why isn't hugely complicated. I mean, there's obviously layers in the ETPs, but they have to be a pretty simple direct bet on one part of the market. So, VXX, you're buying the front 2-month futures, and it's still, believe me, there's a lot of sketch in there, but it's not super complicated how it works out. And it's essentially something people can put in, an IRA or something like that. They can buy vol, they can sell vol. And so to the extent that the products, they can use them in, qualified money accounts and things like that, or it makes it a lot easier. Some of those futures are just harder for people to buy and sell. And it's difficult for some people to get their head around a future. They can usually get their head around like an ETF or an ETP, because it just pops up, they buy it or sell it, and they don't have to take that extra step. So I think as far as launching products, they have to have a relatively narrow focus, not be too complicated, have a structure that clients are used to and can use, and have listed option product, options with decent liquidity. I mean, part of, the VXX trading is that all of that kind of trades in one pit on the CBOE for the most part. And because, it's fungible for liquidity providers for the most part, that liquidity begets other liquidity. It's not going too far afield, let's say, for a liquidity provider, to trade these things. So if I was listing more products, I would think about it on those lines. Like I think an Apple volatility product would probably trade, or maybe a Google not so much, but some of the simpler with an underlying security. You would have to develop some kind of underlying security though for, let's say, the Apple VIX. You would need a future or something like that in order to get things going. I don't think the options, the straight like Apple VIX options would trade without an underlying, because it would be very difficult. It would be difficult for the average person to, it would be a harder thing for them to hedge or to sort of wrap their head around without an underlying they can kind of point to.
That's a good point to bring up there, Jared, and that's something I've bandied about quite a bit with the exchanges and with a lot of people in the vol space. And a lot of people point to the real inflection point for these VIX products being when the ETPs started to seep into the marketplace and generate traction. That's when VIX really took off, the futures and the options. We saw a lot of flow coming into them. Remember, all of these various ETPs, they have to hedge with VIX in some way, shape, or form, so they're driving flow back to the quote-unquote mother product, if you will. And if you look at a lot of people who are now launching products in the space, we obviously partnered with Russell here on this show. They're looking at the Russell portion of the volatility spectrum, and they're spending a lot of time right now going after the ETP providers because they see that as really a huge driver and a huge generator of growth for all of these volatility products and for futures and options products in general. So there's clearly a mindset out there right now that the ETPs are the primary drivers of volume in these products, and you can't really launch a new one, or at least it won't be successful until you get some major ETPs on board driving volume back to it. So certainly there's a lot of money chasing that idea right now, and it's a very interesting one because it gets back to a lot of what we talked about here on the show in the past about whether the tail is wagging the dog or not from a volume perspective as well as from a underlying value perspective. There's a lot of contentious points within that topic. Going back to the futures, of course, like I said, it's the 10-year anniversary of VIX Futures. Not surprisingly, they had a big event commemorating that this week over there at the CBOE. A lot of great speakers like Buzz Gregory over there from Goldman and a few others. They made a lot of interesting points. A lot of them are probably pretty basic for the audience of this program, such as the fact that, steeper the term structure, the higher the basis in a lot of these futures products. That's pretty straightforward. And that also that, of course, the relationship between spot VIX and VIX Futures highly correlated to the term structure of the S&P 500 implied volatility. Again, no big surprise for a lot of our listeners. Buzz did make one interesting comment. He said that you can't trade spot VIX, and that is the case, but as we'll get to in a little bit, that may not be the case for much longer. He also made a point, or actually I believe it was another speaker, Joanne Hill, who made a point that I've heard a lot bandied about these days, which is that rolled positions in the VIX midterm futures resulted in higher returns than using the cash or the VIX short-term futures, again alluding to that roll risk problem, and that a lot of people seem to have come down on that middle portion of the curve as the best way to kind of mitigate that. You go too far out the term structure, you could be paying a heck of a lot from a premium perspective. You go too close, you're getting crushed from a roll risk perspective. It seems like midterm is where the action is right now. Jared, do you agree with these results about the midterm futures being kind of the sweet spot right now?
Yeah, like they've been the sweet spot from the short side in the last, 6 months or so. There's a kind of a story where for immediately after the financial crisis, if you were going to sell vol, doing it in the very front couple months, maybe first through third months was the place to be, and that worked for a while. Since the last 12 months, I think that if you're going to be a seller, selling the middle part of the curve has been the place to go, and it just changes, and that actually brings up a bigger point that I'll just mention quickly. When we talk about changes in the term structure, the way the products have reacted, I think that I'm just kind of skeptical of all the analysis that people do, including myself, based on the last 5 to 6 years of data, because it's just really essentially one big period, this big post-crisis decline in vol and normalization in markets. we don't have a lot of data before that to sort of get a different regime for comparison. I mean, there was VIX Futures, but they weren't active enough, I don't think, for that earlier period to be representative in terms of market impact and flow. So, I mean, all the analysis that we do on the limited data that we have, I think, is in the context of one big declining volatility regime that it makes it all a little bit suspect in the big picture sense. For me, I think that 5 years from now, we'll probably have a much more rigorous sense of how these products react and what they're like at different points in the market that we can't really get right now.
Always good to question your own data, I find.
Well, especially when it's only 6 years old.
That's true.
That's what long-term capital did, remember? They're like, okay, we're going to go from 98 to 92.
Yeah.
And we're going to bet like $3 billion on that.
Hey, I don't want to hear it, Andrew. Mean reversion is the way to go. You cannot go wrong with that strategy.
Well, there's mean reversion and there's risk control with mean reversion. So, if you're going to sell 5 million Vega when at a 13% at the money vol, you're going to get what you're going to get. That's all I'm going to say. You could be right or you could be wrong.
The other big development at least from a VIX news perspective this week, and that's why I wanted to highlight that comment Buzz made about you can't trade the spot, because that's a frequent problem that people have cited, of course, to us here at Options Insider for years. I'm sure Jared, all of your clients, and Andrew, all of your clients you've answered this question a million times. People see VIX cash on TV. Why can't I trade that? They have to deal with the futures and the term structure and the premium, and it's a hassle. And a lot of people don't want to deal with the futures, as we've seen with the explosion of the ETPs, even though they're getting VIX futures exposure whether they want it or not. But an interesting person has jumped into that fray now, no one less than Robert Whaley, considered by many to be the father of many of the products we discuss here on this show, including VIX. And he has jumped into the spot VIX fray now, signing on with a company called AccuShares. And the whole point is to create a bunch of ETPs around the volatility space, including perhaps a spot VIX product. And what he said in a recent interview is that there's room for improvement. Most people who use them, referring to the VIX ETPs, don't understand that when they buy them, they aren't really getting a position in VIX. It's a bit disheartening. There are funds pegged to the VIX S&P 500 indices and lose money because of contango in the futures markets. That's kind of scary. People are buying and holding these for an extended period of time. They were meant to be used for positions in intraday volatility and should be sold by the end of the day. But you can tell that the shares are held for much longer periods, exposing investors to additional costs. Institutional holdings are very small compared to retail, so retail investors must be holding on for far too long. My calculations show that over $4 billion has been lost by investors who have been long these products since they were launched. He's also gone to say that these VIX ETPs are virtually guaranteed to lose money over time. Again, a lot of this not going to be a surprise to the listeners of this program. We've, of course, expounded upon that at length here on the show, that things like VXX and others are really designed for the short term of the spectrum. But we haven't seen much of a solution, at least proposed for that, until now. And that's kind of what they're looking to create here, is a product that's going to, in some way, shape, or form, really replicate the spot VIX. So that when you come in, you see these VIX cash numbers bandied about. You can actually, maybe if this product lives up to the hype, could actually be able to trade that. He goes on to say also in this interview, we've heard that market makers and institutions are very interested in being able to access more accurate pricing and liquidity. This would open up buy and hold strategies by institutions, which make a great deal of sense as a portfolio hedge, even though the correlation is hugely negative. If you can get something that behaves like VIX, it opens up opportunities. Pension funds and endowments would be able to offer a huge diversifier. So interesting stuff. I usually don't pay attention to a lot of these new products in the space because a lot of them come and go, but this is someone with a bit of a pedigree behind him, and if he says he can do it, I tend to give it a little bit more credence. Jared, what's your take on this proposed VIX spot contract, if you think it's viable and what it can actually do in the marketplace if they succeed?
Okay, so first of all, the guys at AccuShares who are running this, I kind of looked them up a little bit, and it seems like they've got probably got plenty of experience to make this work. It looked like the management were guys with sell-side experience in equity derivative structuring. So I think if anybody can make this sort of thing work, it'll probably be them. just from a quick scan through the prospectus the other day, I haven't done a deep dive on this, but my sense is that they're getting around the biggest problem that has plagued anyone who's even thought about doing a spot VIX product for years, which is that trading all those options to replicate the VIX index would be expensive and a huge hassle, right? So that's why we don't have any ETF that does that, because there's some huge costs associated with anything like that. The way they get around that is by calculating the change, and then letting the product move with that calculated change, and then my understanding is give you distributions periodically in shares of the sort of up or down versions of this product. There's this dual class structure for each of these that allow you to sort of keep track with the gains, so there isn't some kind of a decay effect or leverage effect. But there's one note to follow up on, which is that the prospectuses, they have built in a little bit of a decay into the actual calculation, which I thought was kind of a surprise, since it seems like part of the impetus for the whole product is to get around the decay issue that people don't seem to like. Interestingly, though, I think if this methodology is going to work anywhere, I think it'll probably work with this VIX product rather than with. I'm a little actually more skeptical about the different spot commodity versions that they're launching, only because while you can't, there's not a strict arbitrage relationship between this cash VIX index and futures. Spot futures parity should hold between in these different commodity markets that they're looking at as well. So I'd be kind of surprised if they were able to launch a spot product in the commodity space that seems like at least the appeal would be you could avoid carry costs and storage costs and all the other costs that create a role in commodity markets. If you were to buy and hold this spot product, you'd hopefully be able to avoid that. That'd be a violation of that spot futures parity relationship, and I'd be skeptical about the ability to get around that on the commodity side. But like I say, if it's going to succeed anywhere, I think it would succeed in the VIX product.
They seem to have some fertile ground here. I'm certainly, of the two big vol products that have been announced in the past couple of months, this versus the Voldex, I'm certainly more excited and intrigued by this one. The Voldex seems like it has a lot of work to go. They don't even have an underlying really around it yet, so that one has a lot more work to be done, whereas this one seems a little bit more fully baked and more intriguing, quite frankly. Andrew, what's your take here on this new potential for a spot VIX product and the potential it might have for finally ending all those questions? People calling you up over there at Option Pit saying, I thought I was trading VIX cash. What's this futures thing?
I'm a devil's in the details on how they create this thing. I mean, the VIX is creating the index to exactly follow the product, with trying to avoid decay and how to actually create it and hedge risk for the the underlier provider, the manager of it. I'm still trying to figure out. I mean, for my poor little head, I think that's a difficult road to hoe without actually going in and having to buy some Vegas somewhere. I mean, maybe Jared already has it figured out, but I'm still trying to figure out how that happens somehow without, no effect really on the volatility marketplace. But I mean, Whaley's a smart guy. I guess they can figure it out, but I think it's still going to be difficult. I think the problem, I'm still looking at these, what are the nations indexes? I'm looking at them. I'm looking at how they trade, and again, they're interesting. I've been watching them now for about, about a month or so, 6 weeks, usually before I trade or want to trade a product. I like watching how it moves for a while. I'm still trying to get a feel of actually how these products work. So it'll be like anything. They're going to have, I don't see how you create these products without them having some sort of nuance or some sort of strangeness. Just being able to create an exact VIX to do exactly what the VIX does without any slippage at all. I'm a little skeptical, but I could be wrong, because sometimes I'm just, an old guy who just doesn't believe that people can do things like that. But
what's the case what's the investment thesis for wanting to trade a spot VIX versus, let's say, the front month future? I mean, we could bracket, actually, I think let's just bracket the decay fact. I mean, there's a lot of confusion around that, but stuff with an expiration date has a cost to it. That's just a fact of life. It's not like a defect in the product. So if you ignore the time effects and the cost of carry, is there a case for trading a spot volatility product versus a 1 month future, except in a really, really maybe a tight arbitrage, really, really technical way? But in terms of the average investor, who cares if there's a spot VIX?
Well, I think the problem with a lot of people is the future doesn't move how the cash does, and it bums them out. Where they want to buy volatility, so they go buy the future and they see VIX ripping and the future doesn't move because, you get that 1 point vol move and the future premium totally absorbs the move. And for a retail investor, that might be on a percentage basis, that could have been good money for them. And they get angry, right? Because they don't get it. As a market maker, we used to get calls into our pit, when the volatility would move big. How come the stock is down $10 and these puts only move 10 cents? Well, you bought a put that was $30 out of the money. You paid $1 for it, and the stock made its move and the vol came in, And they're like, well, I don't get that. Well, go read McMillan or whatever. So I think part of the problem is everybody wants what they want. So I want to buy the VIX, and when it goes to 14.5 to 18.5, I want to be able to get my 4 points and be done. And I think that's why they're trying to, let's call it, improve the products instead of people understanding with the little education, how do you trade that move? What's the best way to trade an underlying VIX move given where the products are trading? That's education, which of course is why we have a business, Jared. You do, and Mark and I do, and and Longo has his huge 500 different radio shows, is education. So I think there's demand for what we'll just call a super simple product. I'm skeptical of how that super simple product is actually going to act. From your head, you're like, well, why is that a problem for people? So you have to kind of, you have to go back way, way, way back in time to, when options were just this little fuzzy thing you learned about in college. You didn't know exactly how they worked or how the volatility products worked. So I think that's part of what might be the demand for some of these things, just to make it super simple.
You hit the nail right on the head there, Andrew. This is a function of the popularity of the VIX product and the VIX name and the fear index exploding beyond anyone's wildest imagination, being hit upon time and again on CNBC and pretty much every media outlet throughout the globe whenever the market moves a half a point in any direction. The number one response to that from the broad investor populace is they see the VIX cash number. You never see the VIX futures disseminated, pretty much ever. So that's the immediate learning curve they have to encounter, and that's just a stumbling block for a large percentage of the populace. So if you can have any product that can approximate that, that's going to be a much shallower learning curve for them. They can just jump right in and try to at least trade what they see on the screen. So this is all, I believe, a response to the marketing and the demand of this product versus what you're saying is clearly right there, Jared, that from a functionality perspective, it may not be desirable, yet from a marketing and demand perspective, it is clearly desirable. Because if VXX can do what it's been doing with all the flaws in that product, imagine if there was an actually viable spot VIX product. It would blow the doors off just about everything else out there. All right, moving on from the VIX land, at least S&P VIX. We'll touch really quickly here also on what's going on out there in Russell. Like we talked about on the last show, they had a lot of open interest really going into the Feb expiration. Since then, it's been a bit of a quiet period out there in Russell land, but there is some activity going up, close to 1,000 open interest out there in the product right now. And once again, we've talked about it before. Russell VIX is this weird microcosm of the big VIX product. No one wants to play in the RVX puts, which is interesting because we've talked many times about how small cap is going to have a vol premium versus the larger cap of the S&P 500 type products. So you'd think there would be some interest in trying to capture that either from a retail perspective or institutional perspective and trying to put on something to the downside. And yet everything is exclusively in the call wing going out to April and May out here. We even have one crazy optimist out there with a 10 lot of the May 30s out there in RVX. So expecting a bit of a pop in RVX land. All right, let's move on to some other products that people always write in about, want to know more about. We touched on it recently, you and I, Jared, and people got very excited talking about the metals and metal vol, so we're going to dive into it again. Pretty much focusing on the shiny stuff, in particular gold. A bit of a rough week from a gold bug perspective. It hit a 5-week low this week, getting down to about 1305.50. And the futures about 1306.20. Since rebounded a bit from those levels. But again, that goes back to what we've been seeing out there in that marketplace, and people looking for some vol out there in gold. Given this scenario, gold hitting a 5-week low, you'd think we'd see people pretty heavy to the upside in terms of an options perspective and bidding up some of that vol. Haven't seen too much of that. As of today, the COMEX gold out there in June trading around 1294, so it's even off those levels. The DEES COMEX trading around that same level, about 1295, so not really pricing in a lot of premium going out the rest of the year here from a gold perspective. You're looking at the at-the-money vol. It's high, but it's not historically high. It's only about 1540, 1550 or so right here. And looking at the open interest and what's going up out there in the June options, at least, it's still pretty even from a call versus puts perspective. So we're not seeing heavy in one side or the other. We're seeing about 9,000 of the June 1400s open right now, 2,500 of the 1430s and 50s. 8,500 of the 1,500s, so there still are some heavy gold bugs out there. 6,000 of the June 1,600s, and what really cracks me up, so the biggest open interest strike out there in June is the June 1900 calls. 30,000 of those open, perhaps skewing the tape a little bit. And also deep in the money calls, about 12,000 of the 1010 calls open as well. So some interesting paper out there in the gold options. Looking at the put side, it's about the same. We got people trading all the way down. 8,000 of the 1,200 puts open, 6,000 of the 1,100 puts, 1,200 of the 800 puts. So there are a few bears still lurking out there. Overall, the open interest call to put ratio, flipping it a little bit, about 1.5 to 1. So net open interest wise, people still leaning a wee bit long, which is kind of what you'd expect given just the nature of that volume and that flow out in gold. So many gold bugs, you can't really write them off. But still interesting to see what's going up out there in precious metals land. Jared, what's really been catching your eye out in precious metals vol land since the last time we gathered together here on the show?
Gold implied vol is still, in a pretty low level, historically speaking, and relative to the, got a bit of an uptick in the realized vol, but no one's really bidding that up in option premium terms. In terms of the sentiment and positioning, I think that maybe this bear move is actually a bit overdone here. I hate gold long term, or as an investment or any of that stuff, but for a trade, I guess we'd be more biased to the upside. One thing people forget sometimes, especially equity investors, is that you can get a real, nice curve on the upside if you're looking in terms of skew. So even if you have just a mildly bearish view, buying some at the money strikes, you can sell out of the money calls if you're not looking for a major trend to finance the position. I think it makes for a nice trade, and I'm actually working into some of that stuff right now.
The thing that's most interesting to me about gold is watching the 20-day realized vol for gold while we were kind of in QE happydom, let's say Bernanke, everything was, taper. Then gold kind of fell apart last, early summer, late spring, right around there. And the short-term realized volatility picture has changed there. Like we've had a lot more gaps in gold since then. And I'm trying to see if we're going to have substantially more, realized volatility because, if the Fed's kind of getting out of the bond buying business, let's say slowly but surely, they're going to keep rates low. But, the fact that they're kind of jumping out maybe makes gold slightly more volatile on a day-to-day basis than it used to. And you've got implied volatilities working down. I don't know if we're going to see like that 12 or not 10% or 11% or whatever we saw last year right before it blew up. But if you look at, let's say 180-day average volatility, realized vol, gold implied vol is actually pretty cheap. And my thought is maybe people get lulled into the fact of just selling lots of juice in gold when actually the realized volatility structurally for the product can be going up. So as a trade, that's kind of something I'm looking at. Again, for me, gold, it's like Tusaw would say, it's yellow, it's shiny, and people like it. But, if you really can get the implied volatility pressed down in there, maybe the 14 handle or something like that, I think is going to make a pretty interesting purchase. Because I think structurally the realized vol in there has changed. It had one personality, prior to the spring of 2013, and I think it's getting back to maybe a more historical volatile material, just based on everybody's whims without that support. So it is a idea. I don't know if it's a theory. I don't know if it's worth throwing a lot of bucks at yet, but it's definitely something I'm looking at now and see if that implied vol really can make kind of break to some lower levels now that everybody's sort of disappointed that the rally in it has died. All the little gold bugs kind of go away for a while till it starts to rally again. So again, might be a good idea. Like Jared said, you buy some at the money junk and you sell some out of the money junk against it, and you might end up having a pretty decent trade out of that. So I think the realized vol will pick up in there.
All right, and we've been gassing on here in the vol review, but a lot of fun stuff to talk about this week. But I want to make sure you guys get your chance to join us here on the program, so we're going to dive right on into our volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the volatility voicemail segment. Allow me to start this segment off really quickly with a quick apology. I know some of you like to use the feedback form on our website to contact us and send us show questions. And for some reason, over the past few months, we had a bit of a hiccup with that system, and some of the questions weren't getting through, and all of a sudden, a bunch of them did get through for the past few months, including some questions for vol views. So I want to make sure that those of you who wrote into us a few months back and were saying, why didn't they answer my question? We'll make sure we get you guys surfaced here. Starting off with our friend here, Burt Skerton. He writes in, "Hello, Options Insider. I've been listening to your podcast for quite a while and have been trading successfully as a result of the valuable information that you have provided. So for that, I thank you." Well, you're welcome there, Burt. He goes on to say, "I am confused, however, about a situation that I am seeing. I have a position in the VIX where I bought the No 15 put for 80 cents with the underlying at the time of purchase listed at around 16.50. Obviously, this is a couple of months ago, listeners, so bear that in mind. Today, the underlying has dropped to around 13 plus, but the option is only trading for around $1.30. It seems that the option should be worth more than that because it has about $2 of intrinsic value. So in theory, couldn't someone with a large account just buy a few contracts, exercise them immediately, and sell the underlying on the open market for a huge profit? Thanks for clearing this up for me. Keep on rocking." Well, we're going to keep on rocking, Burt. Your question may have been delayed, but it actually came in at an ideal time for us here on the program, because this harkens back to exactly what we were just talking about in the volatility review segment about the use case for a spot VIX product. And what you've just encapsulated here is the reason why so many people are putting so much resources behind a spot VIX product, because it will help clarify some of the issues that you're outlining right here, because this is the exact scenario. The difference between the spot VIX and the actual VIX future is what seems to be hanging you up here. Mr. Andrew, what's your take here for our friend, Mr. Burt?
Well, first, I'd like to say you really need to go and take a gold course at Option Pit, which will answer that question. That was just a shameless plug, though. But this is the problem. The VIX options, okay, I know this is going to shock everybody, have nothing to do with the VIX index. Okay, they don't. All right, what they have is they trade off the future, and they trade off the monthly future for each term. So right now, the April options trade off the April future as an underlying. That underlying can be anywhere within $1, $2, $3, $4 of the index at any given time, just depending. So the thing is, there is intrinsic value for the cash, and that future will settle to the cash on expiration. But in between that, it can be anywhere. And this is part of the problem where people are just saying, I want to buy the VIX here. I think it's going down. The thing is the future might be trading, in his case, he wasn't getting the future dropping as far as he thought it would, which is not generating the dollars for him on his trade. So what happens is the cash can drop, but the future doesn't drop, which makes your put not go anywhere. And this is, again, understanding the products you trade, why there's the educational services. So that's what you have to understand, really. It's why you have to know, option basics. The easiest way to get around this is, one, know where the futures are trading, but know how to trade a combo. An option combo will always tell you where the market makers think the underlying is trading. So if you buy a call and sell the put the liquidity provider's way, which means buy on the bid and sell on the offer, you'll always know where the liquidity provider thinks that underlying is trading. And you look at that versus where the fixed cash is trading, you're like, wow, that's like $2 away. I must be doing something wrong. Most likely you're not. So what's important is basically what I just call, option basics, where you have to understand and be able to read an option screen first, probably before you start trading options. And at least my experience with the people that have come through Option Pit, 99% of the people that trade options right now do not know how to read an option screen properly. And if they did, they wouldn't have the problems with the VIX. So you got to learn.
Combos, synthetics, you're blowing his mind. You're blowing poor Burt's mind right now, Andrew.
I know,
but you're saying the right stuff, because that is exactly the problem. And Jared, you asked before, what is the use case? What is the reason for a spot VIX product? I think Burt's email outlines exactly why so many people are going after this, because there clearly is still an audience. He's sophisticated enough to understand the existence of VIX and want to trade it, and yet the other issues we mentioned, term structure, futures versus the cash, that is where he's getting tripped up. So clearly guys like Burt are the reason that there's so much effort being put into the VIX spot product. Does that register for you now?
I think you guys are totally right that it's a response to some really serious demand, and like they say, when the ducks are quacking, they're going to get fed, and people seem to like that. What I do like about this case, about Burt's position, is that he's not just buying way out of the money VIX calls outright, like you see a lot of times in the flow. I mean, buying a VIX put is evidence, I think, a lot of times of a little bit better understanding of what's happening. You can capture that mean reversion or that roll yield a bit with a VIX put or a VXX put. So I like to see that, and I think I think you can even extend Andrew's point to people who there's still some people who, whatever platform they're on, may doesn't have VIX futures, but extend Andrew's comment that you can use take put call parity or combo and figure out where the VIX future is just from the screen. You don't need a special quote or special sort of field to get that data. And I think that's a great way to think about it.
See if we can squeeze a couple more here on the old volatility voicemail segment before we go. First off, Jared, a lot of people responded to our recap of RMC. They liked that, and a lot of people wrote in, including our friend here from Brighton Capital. He writes, very informative show with Jared Woodard yesterday. Do you have a similar post-FIA BOCA discussion in the works? And they're referring, of course, to our last episode where Jared and I kind of ran through all the salient points from RMC. If you haven't checked it out, listeners, I encourage you to do so. A lot of interesting nuggets coming out of that conference. Unfortunately, a lot of people asked about BOCA, and BOCA isn't as much of a content-heavy type show. It's more you go down there, you show the flag, you do some networking. There are some interesting developments, like on the cybersecurity front and on the exchange front. We did mention those on our upcoming episode of Trading Tech Talk, as well as our Futures Options Roundtable, where we went through a lot of the global volume numbers coming out of FIA from a global derivatives perspective. So we kind of broke it down into a variety of the different shows on the network that address the different topics coming out of BOCA that are relevant to those different audiences. But overall, one big BOCA kind of rundown show? Not really, because RMC really seems to be the much more content heavy for our listeners anyway, and much more interesting for a lot of our audience. All right, another quick one. We have one. We get a lot of these people writing in with different takes on different indexes and vol products, and we usually don't surface them on the show. But this guy gets surfaced today because he has one of the better Twitter handles I've seen in quite a while. This comes in from @VikingWrath. Twitter. I just love that handle. And speaks to the old history buff in me. He writes, the market is iffy here. What are your thoughts on UVXY in the short term? UVXY is the ProShares Ultra Short VIX Short Term Futures ETF. Yet another in these ultra short VIX products. I know, Andrew, you take a bit of a dim view on a lot of these leverage VIX products. We haven't really talked about UVXY really on the show before. What's your take on UVXY right now?
Do I want to own it? I'll tell you what a strategy that's not bad on them, though, is you know they're kind of going to decay. So what I've been doing here as the vol is getting lower is you buy an out of the money call spread on the trade on, let's say, UVXY, and you buy an out of the money put. So if things blow up, the volatility in the UVXY usually, gets hyperbolic, and you can unwind the whole thing. And what it does is, if you're wrong on the decay and it slides away, the call spread actually generates positive theta from skew, and you can still be long the put. So it's kind of a way to trick the decay that's inherent in the product by using the skew and the options. If everybody's just heard that and went like, their head just melted, that's something we use when we want to get long volatility, but we're really not sure on the duration. So right now we've got lower vols in those products. So to me, they're all about the same. Just UVXY kind of rots faster than VXX and some of the other ones. Again, it's reliably crappy. So it mostly does what it's supposed to do when it's supposed to do it. It just tries to do it a lot faster. And the fact that it's buying, it's double leverage means you kind of get double whammied on everything. So a product like that to me is more like a day trade. That the time spread structure will work on it, but it moves pretty sharp. So you have to be careful of the strikes you pick. But it's reliably crappy, and you can like reliably crappy. So, but again, shorter term even than VXX, I'd say.
Oh, so 8 minutes.
It is a 22-second trade. Is it a scoop right now? It is if the Russians decide to invade, the Ukraine.
There you go. There you go. I like it. The 22-second trade. Maybe that's the title of our show this week. Unfortunately, that's all the time we have for the volatility voicemail, but keep those questions coming in. Don't worry, we'll get to you on an upcoming show. And now we have to keep on rolling right on into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, welcome to the Crystal Ball segment. As the man said, this is the portion of the show where we look ahead and tell you what we're watching from a vol perspective for the coming week. Andrew, since you don't get a chance to come on the show that often, we'll give you pride of place yet again. What is catching your eye? What are you watching? What are you anticipating from the world of volatility in the coming week?
Real strange. I'm going to do the Costanza because I've been watching realized vol close to close and thinking, we should see lower vols, but I think the 13 handle is just proving too insurmountable in VIX. I don't think we go through it. I also think vol probably starts to uptick slightly. There is some sort of undercurrent in the market that's keeping, I think, volatility up a little bit, and I haven't quite seen it leak away. So I'm going to say, if anything, the 13 handle holds for sure. We don't get below it. Possibly higher VIX numbers for next week. And I have to assume that those vol future premiums are going to come in a little bit, but they haven't. They've been awfully sticky. So that's where I am. I'm kind of leaning more toward vol drifting higher, if anything.
Jared, what about you? What are you watching for the coming week from a vol perspective?
Okay, two things. If I can borrow that mantle from Don Schlesinger, I'm not going to be long vol in a big way. But one thing they have been doing recently is extending the maturity a bit. So, pushing things out in time, which is for me about the equivalent of getting long vol, just sort of getting short stuff that's, longer maturity, and actually reducing size on those a bit as well. Just there's a whole slew of reasons, but I've gotten impatient trying to wait for this stuff to break lower in terms of short vol, and so I'm, not throwing in the towel, but definitely moving out the curve a little bit, because I think there's just not a great risk reward for the very, very short term. Second, if we do see we see more news reports of Russia, amassing soldiers and tanks on the border of Ukraine, and something I wrote up for our research product recently was a trade. So BP has big exposure to Rosneft and to Russia. In fact, there was a note from Credit Suisse a while ago that all of BP's oil production growth is slated to be attributable to Russia. So if you take that out, if there was big sanctions, and BP couldn't get at those resources, they'd have to find production elsewhere. So that's been something that's actually been a couple articles about that now in the news since we wrote this up. Seems to be getting a little bit of a little more attention now. But I like that trade as a hedge if things go really wrong. The long-term beta picture looks nice too. BP typically trades 1 to 1.2 times SPX in terms of beta. In the last year or so, it's been more like 0.8. So I think there's a lot of room for some downside risk in the stock if things really go crazy. And so that's something we have on. Like I said, I think there's enough risks in the margins that getting a little bit less aggressive now is definitely the move.
I like it. Don Schlesinger infecting you, getting you to the dark side. Next thing you know, you become on the show saying options die a little every day, and the Iron Condor is a iron fly for cowards. My favorite Don Schlesinger quote, one I take personally to heart. A couple other categories people always want us to talk about, the ags and others. Didn't get a chance to hit them in the vol review. Just want to mention from a crystal ball perspective, if you're playing the ags from a vol perspective, coming up on the 31st, we of course have the USDA quarterly grain stocks report, a big driver of vol traditionally. Seeing people starting to load up on a little bit of downside out there in case this doesn't play out as expected. 4 of the past 7 grain stock reports have showed limit days as a result. So if you're looking for some vol out in the grains and you're not aware of this, you need to be paying attention to this, because this is where a lot of the big action, people particularly looking at corn, they're thinking corn may fall pretty aggressively after the report, even though long-term demand is pretty strong. So people have been loading up on some near-term downside. As a result, we're seeing vol catch a bit of a bid out there going into the report. Also in the esoteric product category, I think the German renewable power sector gets the vote this week, with a lot of vol creeping into that area, talking a lot about how renewables are starting to flood the market over there, causing a lot of vol in those products. So people are always asking, hey, what about some of the more esoteric stuff out there? And the volatility in the German power market, it doesn't get more esoteric than that. And it's looking to move, particularly as renewables get to about half of the overall volume out there, and the way it's structured with the weather, it could really cause a lot of intraday fluctuations. If you're looking for some interesting products from a vol perspective, in addition to all the main ones we talk about on this show, then that should do it for you. But unfortunately, that's also going to do it for us here on the old Vol Views panel. But before we go, really quickly, let me check in with each of my cohorts, my partners in crime, see what they have cooking in their respective necks of the woods. Starting with you, Mr. Andrew, you hit on that gold course earlier in the show. Tell us what's cooking with that and what else is up over there at optionpit.com.
We launched a little gold course. You could start to, for the instructional part anyway, you'll be able to just, you can stream it right from a web page as opposed to downloading now. So there's, golly jeepers, there's a lot of content, probably 12 to 15 hours of recorded, plus another 2 hours live per week, plus so there's a lot of content in the 12-week course for people to learn about options, especially all the stuff we covered here today. We do that stuff on a daily basis, so our clients are aware and educated. And that launch, so far it's going fine. Do we have anything new going on? I'm writing a basic option trading course with my compadre Mark. which will be basic. And that, that'll probably be done in a couple of months or so. And that's right now about it. That's what we got going on. We're just busy taking care of all the people that we've got.
And Jared, what's cooking over there at Condor Options and Klineman Financial Group?
So we're managing accounts at Klineman, and I think we're doing a good job of that. And at Condor Options, we've got if you want to trade some iron flies for cowards, if you want to trade some condors, we're doing that still, and off to a great start this year in that strategy. The volatility tracker research product that I've been talking about a lot has put out, I think, some great stuff, and clients seem to really love it. And I'm working on I do kind of one-off pieces as well as the regular cyclical stuff, and so I'm working on some work on realized correlation, as well as some energy sector basket trade ideas that I'm writing up for the next week or two. So a lot of stuff on the research agenda.
All right. If you want to check out all of those products and more, you can surf on over to Klineman Group. That's Clinamen. You couldn't have picked something that people can spell easily, Jared. You had to give them a little bit of a challenge. That's KlinemanGroup.com, or head on over to CondorOptions.com to check out all the Condor Options goodness he has over there. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you guys out there in the listening audience for downloading and streaming and subscribing, and for, of course, writing in with such great questions. Keep them coming. I promise we'll get to them soon. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.